As you guys know, we have covered many different concepts. I actually created a whiteboard on the Myron platform. I'm going to go ahead and actually share with you guys how that actually looks. But essentially what we have here is that in this dashboard, we are using this as a mechanism where we can all collaborate when it comes to these different concepts. So I created this so far. The last class, we actually taught just using this entire whiteboard. And if you zoom in into the whiteboard, as you can see, I've added many different things, external range liquidity to internal. There's price action. This is actually what we're going to cover today. But I really want you guys to actually review and go back when it comes to the materials. Why? Because there's some really critical things. And I truly believe that if you want to get more into a institutional way of trading, you need to understand the foundations of liquidity and also imbalances when it comes to the market. So with that being said, let's do a quick recap. Let's do a quick recap just for a second. Can someone tell me in the chat? Can someone tell me in the chat what makes a liquidity sweep? Your email? Oh, that's weird. Do it one more time. 1 second. You should be able to see my desktop number 2. Drop a one if everybody can see the Myron dashboard. Okay, excellent, excellent. Okay, excellent. Can anyone tell me what makes up a liquidity sweep? What is a liquidity sweep? Why do we care about a liquidity sweep? Continuation? Okay. Anyone else? Anyone else? What makes a liquidity sweep? Orders? Anything else? 2 fair value gaps? Okay. Why do we care about liquidity? What is liquidity? What is liquidity? Drop any 1 word, 2 words, whatever you guys want. What is liquidity? Why does the market go after liquidity? These are things that we must know. This is the foundation. It's food, right? It's fuel for the market. It's fuel for the market. And then on top of that, the market, all it's doing is taking people's money. I'm telling you, I've never seen any sort of operation this is the most gangster operation in the world. And that is the stock market and futures trading and Forex trading. Why? Because above those highs and lows, why? We have what? We have resting stop orders. And those orders are your stop losses. So the market is going after your stop losses. Why? Because once they take your money, they have the opportunity to go to the next target, right? I really want you guys to understand that the market goes from what? The market does 2 things. The market goes after liquidity and it rebalances price. Why? Because the market is well, the goal is to offer fair value when it comes to price. So here we go. For today, we are going to focus on this quadrant of the Miro dashboard that we created. And with that being said, the first thing that I really want you guys to understand is that, again, everything here is institutional price action when it comes to institutions. I also want you to understand that it's you versus you. And I really want to make sure that you guys win. Make sure you win when it comes to your battle against yourself. Why? Because that is the only way that you'll be able to that's the only way that you'll be able to get this stuff together. I would also say this, all these concepts that we're covering, you got to make sure that you actually do some sort of chart time. If you do not spend time looking at the charts, you're wasting your time. You're better off and enjoy your Wednesday evening, go out to dinner, get some margaritas, get some tacos. You should be good to go. This is for people that are really serious about their future, and they're also really serious about making sure that they actually obtain a skill set. I posted this yesterday on my story. The money is great. Listen, money is great. It solves a lot of problems. Once you get money, life becomes easier. But I care about the skill set. Why? Because once we start to obtain skill sets in our community, now we can amplify it and propagate that, just like the coronavirus, across our community, right? So we want to get skill sets. And this is one skill set that I truly believe can definitely provide lots of freedom for people. So with that being said, drop a yeah.
I think one thing too that we want to talk about is this is part 3. There's part 1 and part 2 that has been delivered. So if we do have some new folks, actually we have about 62 plus people on, and probably some people might see like some of the new terms that we covered in part 1, part 2. We definitely encourage everybody to go back to part 1 and part 2. We'll make sure we share them. We'll work with Aaron to share them in there and basically understand, because now we're getting into a little bit more, I would say, advanced slightly from part 1 and part 2, but Chris does an excellent job currently giving like a recap of it. So yeah, sorry, I didn't want to interrupt you, but
No, you're good. You're good. No, you're good. You're good. You're good, bro. Yeah, and again, Martin is hitting you right on the nail. For those that are new, when it comes to the series, we did a part 1 and a part 2. The part 1 was really basic when it comes to liquidity and what is a market structure shift and things of that nature. Now we're going more to like inversion, fair value gaps, changing state delivery. These are things that are not super advanced, but they require the foundation of part 1 and part 2. So we're going to share the links when it comes to that. Also, for those that want the Miro whiteboard, I will share with you guys now. The only thing, matter of fact, I'm going to go ahead and just lock everything. Just please don't remove stuff. Like, for real, like, I don't have to do this stuff. I'm doing it because I truly care and want everybody to learn. And this is a free resource that I think that we can all use to collaborate and just work together. Okay? Drop a 1 if you're ready. Drop a 1 if you're ready to understand order flow shifts. I can guarantee you that if you pay attention today, if you take this into account and you practice it and you implement it, there's no way you won't become profitable. Like, honestly, there's no way that you will not become profitable. So here we go. So first, we're going to cover inversion fair value gaps, right? So before I even cover the definition of what is or what makes a inversion fair value gap, shout out to Aaron for putting the part 1 and part 2 link of our YouTube. Please make sure to like and subscribe. That would always help the algorithm, and other people can also see it as well. Before we talk about the definition of what a inversion fair value gap is, I think it's really critical for us to talk about what is a fair value gap in general, right? So this right here, can someone tell me, is this a bearish or a bullish fair value gap? Drop a 1 if you think it's bearish. Drop a 2 if you think it's bullish. Okay, lots of 1s. It is bearish. So for those that are new to the series, what is a fair value gap? A fair value gap is basically what we have candle number 1, right? So we have this candle right here. 1 second. So this is candle number 1. We have candle number 2, and we have candle number 3. Now, what makes it a fair value gap? Well, there's a gap between the low of the first candle and the high of the third candle. What does that mean? This gap right here, price moved too quick. There was inefficiency here. So more than oftentimes, price will actually come back into the fair value gap. It can either respect it and continue going back down, or it can disrespect it and continue back up. I really want you guys to pay mind to the disrespect and the respect. Why? Because when it comes to the market, when it comes to liquidity, when it comes to imbalances, when it comes to all these different things, you have to understand that price is either respecting or disrespecting, okay? This right here is a bullish fair value gap. Candle number 1, candle number 2, and candle number 3. What do we see here? Well, we see that there's a gap between the high of the first candle and the low of the third candle. So this area right here, consider it kind of like a bullish zone, right? For those that think about demand zone and support and resistance, consider this like a bullish zone where price can always do the following. Price can come back here, boom, 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 respect it, and continue going back up. Now, how about the times that price disrespects and goes lower? How does that look like? And that right there is the definition of a inversion fair value gap. So first of all, we have here 1, 2, 3, right? Here we have 1, 2, 3, and 4. Can someone tell me what's so crazy about this right here? What did this candle do? We closed what? Drop it in the chat. I really want you guys to be engaged. We closed above, right? So we closed above the first low of the first candle that it was a bearish fair value gap, right? It is also a engulfing candle, right? Which also means displacement towards the upside, right? Engulfing candles just basically mean that it's giving us direction of where price actually wants to go, right? So we have first low and then we have the low of the third candle, sorry, the high of the third candle. When price goes up and closes above the low of the first candle, let's say, for example, this price is 396. What does that mean? We just disrespected the bearish move down. Now, what does that tell you? It tells you that price no longer wants to continue going down, and that price wants to do what? Price wants to continue going up. So essentially, this bearish fair value gap turns into a bullish fair value gap. Drop a 1 if that makes sense. If we have a bearish fair value gap and price closes above it, hence disrespecting it, that bearish fair value gap is now a bullish zone. It is also an order block. I'll talk about order blocks later on. That is also order block. But again, we need more context to define what an order block really is, right? So we're going from bearish, price closes above. Now this becomes a bullish zone. Why is this so important? Well, the reason why it's so important is because this right here, sorry, 1 second. This right here, this entire zone now becomes a bullish zone. Why do we care about that? Well, we care about that because now price can essentially do the following. Now that we closed above, price can come back down into the inversion fair value gap, or now into this new bullish zone, and they can go ahead and respect it and continue going back up. I'm going to go ahead and talk about the bearish one, and then we'll go into the chart, and I will show you the amount of trades that anybody could have taken, just knowing that when price disrespects a fair value gap, is basically a shift in order flow, a shift in momentum, a shift when it comes to what price is doing. All right. So this right here is a bullish fair value gap. It's very clear. There's a gap between the first candle, the high of the first candle, and the low of the first candle. Why do you guys think that whenever I signal a trade within a fair value gap, I always say price cannot close below the high of the first candle? Why? Because once we close below the high of the first candle, that basically means that now this bullish fair value gap is now what? Once we disrespect a bullish fair value gap, it becomes what? A bearish fair value gap, or a bearish zone. So now this zone goes now to bearish. So what can price do? Price can literally go down, tap back in, respect the 50%. We talked about the 50%, and then continue going back down. That is a inversion fair value gap, and you're going to see that across all time frames: 1 minute time frame, 30-second time frame, 15-second time frame, daily time frame. So we'll show you guys how just based off of that single concept, you're able to catch some good trades, right? Here's one example. I think this was Euro USD, January 2024. But essentially, I just want to show you guys how it would actually look on an actual trade. So what are we seeing? Bearish fair value gap, right? What did this candle do right here? Can someone tell me? This candle right here, what did it do? Just drop it in the chat out loud or whatever you want. What did it do? That candle right here. It closed above. It disrespected. So essentially, what is price telling us? We're going up higher. We don't care about the bears or who's selling. We care about now the order flow just turned on and is now bullish. So once we get here, and by the way, I do know people, I wouldn't recommend it. I would say get as much information as you can, but I do know people that as soon as they get a close above a fair value gap, they enter a buy, and they will just put probably their stop loss at the low. And as you can see, even if they put their stop loss at the low, this is still a very profitable trade. It never hit your stop loss. But more than oftentimes, when we do get that closure above, price will always leave behind what? A fair value gap. And this could have been an entry. This could have been an entry. This also could have been an entry. This entire zone went from bearish to now being, quote unquote, a support for bullish order flow. And as you can see, we went ahead and we liquidated these highs. I can guarantee you that even if you get in right here with one contract from this area all the way to this high, you're up about 700, 300 bucks. I mean, anywhere from 300 to 500 bucks easily with one single contract. Two contracts, you could easily top $1,000 with just what? A simple model that you can follow and that you got to visually train your eye to be able to identify that model to then be able to actually take those trades. Let's continue. This is another one. What do we see here? Same thing. Bearish fair value gap. We see the gap right here, right? Bearish fair value gap right here, bearish right here. What happens right here? We finally get a close above. Price never disrespects this now bullish zone, and price does what? Price continues going back up, going into this buy side liquidity. Drop a one if you're ready to see this, how this works on the 1 minute time frame. Matter of fact, I'll show you 1 minute time frame, 15-minute time frame, 1 hour, whatever you want. I'll ask you guys and just show you how you guys can actually use this to your advantage and be able to scalp all day. So here we go. I'm going to use.
Yeah, I was gonna say you're probably gonna do what I was gonna say, which is a perfect example would be today's NQ. You know, by the time you called out that trade, like we literally were in that range and we could not break it at all. So maybe look at the why you sent out the signal and why you stayed in that trade today.
Well, a couple different things. If you look at, for example, for those that have the reserve indicator, I really hope you guys are using it. This simplifies everything. Like it truly simplifies what you got to do in the morning. So most people ask, Chris, what do you do in the morning? Like, what are the things that you look for? Honestly, in the morning, all I do is literally go like this: turn off, turn back on. Why? Because this tells me the London high. And matter of fact, let's go ahead and get some annotations here. You guys know that I like annotating on the chart, right? This is the London high up here. And we also have here, right? We have our London low. So why do we care about that? Well, price has to hit one of those targets. It's really that simple. I want you guys to only take trades when there's a draw on liquidity. Why? Because when there's a draw on liquidity, or if we hit one of these targets, it will always give us what? It will always give us a high probable setup, right? So I really want you guys to always think about, you know what? No liquidity, no trade. Draw on liquidity. Okay, then now I look to see whether or not there's a fair value gap or order block, inversion, fair value gap, things of that nature to then get into the trade. So if we go back to 930, actually, this is actually 934, we can see that what? Price instantly went where? To the low of London, which was 19607. So now we wait. I would always say wait 2 candles. Why? Because we want to see whether or not it is going to be a liquidity run or a liquidity sweep. What makes a liquidity sweep or a liquidity run? Well, it's going to have a overlapping fair value gap with that level. So even here, we are still looking to see how we can get an entry. Price is still displacing, right? And now we created what? A low right here, right? Price is still going down. Price is still going down. We still coming down, whatever. We're just consolidating here. I know a lot of traders here got smoked and got pissed because of this consolidation zone here on the 1 minute time frame. But essentially, as soon as we get an entry or a body candle below, that body candle is telling us the intention. What is the intention? Well, lower, right? Because if what did we do right here? We took out liquidity from this 1 minute time frame right here, right? So what happened here? Price just continues going down, continues going down, continues going down, continues going down, right? And price will always do this lower low, lower high, everything like that. For those that do not have the reserves indicator, the reserve indicator was an indicator that we just created. For those that do not have it, please send me your TradingView username, and we could definitely go ahead and get you added. Again, we add you for free. That's another free resource. We could have easily sold that indicator. I keep telling you guys, I could care less about the money. The money we're gonna get to it regardless. So send me your TradingView username, and we'll definitely get to it, right? But as I see this drop here, what am I also trying to identify? Well, there's a fair value gap right here. There's a small fair value gap right here. Look at this, right? And this candle right here is what? Is respecting the fair value gap, right? For those that do not have a fair value gap indicator, you can use ICT imbalances by Fadi. It's really, really good, right? So as long as price continues to respect this fair value gap, well, that's another opportunity for a sell. And where can I put, and by the way, just look here. You know the amount of people that will get out right here just because they see the candle going up? That's what the market wants to do. The algorithm's job is to fake you out thinking that price is going to close above. And what do we see? Bearish fair value gap. Have we gotten a body closure above? Type yes or no. Have we gotten a, so no, if it's no, right? If we are not closing above, what does that mean? We are respecting bearish order flow. So I'm actually going to go ahead and just close my trade out here because I really want you guys to see, how do I take these small scalps? Let's say I got in here. What's going to be my take profit? Well, that can be a take profit. Why? Because that's resting liquidity. This right here can be a take profit. Why? Because that's the last low for $375. One single contract. And let's see if we hit it. Do we hit it? 1 minute, 2 minute. Okay. And what happened here? We rejected one more time. Rejected one more time. No closure above. Let's see. A couple minutes afterwards. Boom. And it hits it right there. And actually for 905 from one single contract. Using what? Using a little fair value gap that I could honestly teach my godson to identify that fair value gap and sit him right next to me. And he could tell me, yes, that's a fair value gap. Okay, cool. Then what do we do next? Well, next, we try to see whether or not price is going to close above it or price is going to close below it. Phenomenal question. Where would you place your stop loss? So let's go ahead and just backtrack just one more time. Let's bring it right here. And let's say, for example, we got into the trade when price came here for whatever reason, right? Where would I put my stop loss? Well, you could easily put your stop loss. Usually I try to put it just a tad bit higher than the first candle's low. Why? Because if you would have put it here, you would have gotten stopped out. Because the market knows that the retail traders, the breakout traders, the beginners, they're going to put their stop losses there, right? So I'd rather put it just a tad bit higher right here. Cool. I'm cool with risking 345 to be able to make 310. Sort of like a 1-to-1 risk to reward ratio, right? And price continues, right? Comes up. And by the way, that did hit my stop loss there. And that's because we actually came back up to an order block. That's a small order block, which we'll talk about here in a second. But for any other example, I tried to put it just a little bit higher than the first low of the first candle of that fair value gap, right? So every single time that we see a fair value gap, and by the way, I'm covering stuff from part 1 for those that are here today that are still new, right? So we see a fair value gap. What's next? Well, we want to be able, we first wait to see if price retraces, right? As long as price respects price, hence rejecting, right? That is an opportunity for a buy or sell. What are you targeting? Resting liquidity. It could be the last swing point. It could be a PD array from a higher time frame. But those are ways that we're able to trade just using fair value gaps. So let's continue, right? Let's see when price gives you another entry. And what are we seeing? Displacement, displacement, displacement. Price is just, going down, right? So now I'm going to mark this last low here of 19422 as the last low. And what do we see? Another fair value gap that was just created. Somebody else could have gotten in and they would have been profitable today, right? But I want a really good entry. That's a good entry right there. See, I like that there. I like that there. And for those of you that may not know, you have to be comfortable taking a sell there. I know it's scary and all this other stuff, but the only reason why you're scared is because you're scared of being wrong, not about losing money. A lot of people care about being right all the time. And those people that care about being right all the time, I can guarantee you, you will lose a shit ton of money here in the market, right? So I'm seeing that price is rejecting. So I'm going to follow my recommendations. I'm going to put price right here. So I'm risking $185 to make 545, and let's see what happens. Hit. That easy. It's that easy, right? So 185 was my drawdown there. Well, not even drawdown, because I never got into a drawdown, but 185 was my risk, and my reward was $545. And how? All I had to do was mark up or turn this indicator that lets me know where's the fair value gap and whether or not we're respecting the fair value gap. As long as we do not get a closure above the first body candle, I could care less what price does. And I can guarantee you, you're going to see ups and downs, ups and downs, ups and downs. That's just the market trying to trigger your emotions, because it knows that humans do not do well with emotions. That's the reason why everybody's investing in what? Automation, in AI, in bots, because that way we could definitely get a better reward. So that's one trade right there. 2 trades back to back. Look, it only took 1, 2, 3, but 2 minutes and a half basically to be able to understand that. Yeah, I think you can use, I think it was, no, it's not that one. One second. Yeah, it's one of these tools that you're able to use. Like, for example, if you want to get into a short position or if you want to get into a long position. I'll find it here in a second, and I'll show you how to actually use that to understand your risk to reward on every single trade. See? And Shah, you know how to trade fair value gaps. Anybody that traded fair value gaps today, even if you didn't catch the whole move down on NQ, you still made money. And that's all that matters, right? Is you making money. Now, let's go ahead and find a inversion fair value gap, right? So I want to find a inversion fair value gap, and we're going to go ahead and get that done now. So let's see. Continues going lower, price is going lower, price is going lower, price is going lower, still displacing, right? What do we see right here? That's a bearish fair value gap that turned what? Can anyone tell me? That's a bearish fair value gap that now became bullish. So we treat it just like if it was just a regular fair value gap. As long as if price comes like this and stays above, we can get into a buy. If price comes back down, then we continue selling lower. So let's see what happens on the next candle. Next candle, let's see. Price is trying to go higher, higher. Let's see. Do we respect the inversion fair value gap? Yes or no? Are we? No. We don't. So what does that mean? Sell. Okay, 250, not bad. That's good for dinner. 250, let's see. Let's see. Let's see. Boom. Right? And price will always do these fake out moves all day. But what is the bias? What's the bias? Well, our information is that we had a bullish zone that closed above. That body right there tells us everything. I want you guys to understand this. The wicks do the damage. The body tells you the story. The wicks do the damage. The body tells you the story when it comes to direction. That's why more than oftentimes I always say we need a body closure above. Because once we get a body closure above, that means that now we have confirmation that price wants to continue heading lower. Mind you, we took that little L earlier, 710, one single contract. That's pretty good money in one single day. Barely, not everybody makes that type of money in one single day. I can guarantee you that, right? What do we see here? Another fair value gap being formed. Mind you, it's 12 o'clock. 12 o'clock is probably one of the worst times to trade, and we're still looking at entries, right? What do we see here? That's also what? A inversion fair value gap. So let's see what happens. Mind you, we just created this last low that can serve as a liquidity target. This is the 2-minute time frame. 2-minute time frame, which I don't really use, but I'm just showing you guys how this is fractal. And what do I mean by that? It means that every single concept that I've been teaching the last couple of weeks can be applied to any time frame, any single time frame, right? And what do we see here? We got a body closure above. And actually, I'm going to go ahead and just draw this out. This was the fair value gap right here. So let's say, for example, I'm just gonna play right here. Let's go here. Right? We have a body closure above. Bearish fair value gap turns bullish. Let's see the next candle. Boom. Next candle still closing above. So let's say, for example, we got into a buy right there. What are you targeting? What's going to be your take profit? Anyone? What's going to be your take profit? Where would you place your take profit if you got into a buy right there? Last high. So we can easily go like this. We can say this and make what? 315. The next fair value gap. Why? Why the next? Why? Because price is going from external range liquidity to internal range liquidity. Price is either going after liquidity or rebalancing price. So let's say I'm going to put it, I always put it at the 50% always, because more than oftentimes a fair value gap will get tapped into the 50%, which is called a consequent encroachment, right? So this is what, $385. I'm going to go ahead and put my stop loss. Matter of fact, I'm going to put it right here, because if price closes below, it's telling me what? We are now heading lower, right? So I'm basically going to risk $65 to be able to make 365. Boom, next candle. And where does price go? Anyone? What did price do right here? Right here.
That's that fair value gap.
Fair value gap. And we respected it. Hence what? We are heading lower. We're now going what? After more liquidity. Where's our liquidity? Well, our liquidity is right here. That's what, 635. Let's put our stop losses. Matter of fact, I'll put the stop loss right at the high of that fair value gap, 295. I'm risking 295 to make 635. Let's let it play. Okay. This right here confirms it. That body closure below that fair value gap confirms it all. We are no longer respecting that bullish zone, which tells us what? We know where price is going. That's why I put in the chat, price is going to 19284. And you guys see me a few minutes later, screenshot, here you go, boom. Why? Because I understand liquidity and I understand the concepts that are giving me the confirmation to understand the narrative and the direction of where price is going. So probably next candle. Let's see. Let's see. Let's continue. I'm not scared yet. No, boom. There's no reason to panic over that. And what do we get? 1245 for a day for 3 different trades. By the way, I do not trade off a 2-minute time frame. I did not take these trades. So I'm not like cherry picking these trades. You guys can give me any chart and we can run it up. Okay. So that's what I really want you guys to understand. Now, let me show you guys a trade. I think it was from last Friday. That was really good on the 9:30 a.m. Here we go. Let's go here. Let's play the 9:30. Yep. I'll answer that in a second here when it comes to the 1-hour time frame. And honestly, if you guys can do this on the 1-minute time frame, the 1-hour time frame shouldn't even be a concern, right? But here we go. 9:28, 9:29, 9:30, right? Price goes down. Have we perched the high or the low? Not really. So we still got to wait. Let's wait. See this right here? What is that? Anyone? That is a what? We just talked about.
Inversion.
That's an
inversion.
Beautiful. That's an inversion fair value gap. Body closure above the previous bearish fair value gap. Honestly, somebody crazy enough like me, I'll take risk. I love risk. That's the easiest cow because I know that for sure we're gonna go up. Boom. That's 685. Beautiful. Okay. What are we seeing right here? Price is now respecting this new bullish fair value gap. Let's see what the next candle does. That lets me know what price is respecting it. We can definitely go up. And I think that we went to the last previous day high. I'm just gonna put in a high here, which I wouldn't, but I just want to see where price actually went to, right? Yeah, and it went to like a previous day high. And that would have been easy money right there. Just understanding what? Just understanding that a bearish fair value gap that gets disrespected becomes what? It becomes a inversion fair value gap, hence a bullish zone. Let's play it back because I got you guys with a perfect entry. And I'm going to show you guys and give you guys some gems on how time and price is what determines the market, right? So 2-minute time frame. Here's 9:36, right? This is 9:38. We swept London lows. We closed below, meaning that what? That price may want to retrace. That's something important to know. We swept liquidity. The wick did the damage. The body closed below, letting us know what? That it may retrace and try to pick up some orders that it left behind, hence the bullish fair value gap. And what do we see? We pop back up. Why is this a good entry? Oh, sorry. Let me go ahead and put this back. Sorry, everybody. 1 second. Sorry about that. Why is this a perfect entry? Can anyone explain to me? Anyone? And I want you guys to, yep, go ahead.
Now, I was just gonna say, is because it respected that, consequent encroachment. So 50%
Respect,
of the,
yep.
fair value gap.
Beautiful. Respected consequent encroachment, right? Bearish fair value gap turns into bullish. More than oftentimes when you do see this, by the way, it will look something like this, right? So let's say, for example, this is I hate doing this, but how do I explain this? The reason why this is a good entry right there on this candle is because price closed above the bearish fair value gap, now turning it into a bullish zone, an inversion fair value gap, and we treat it just like a regular fair value gap. Price will always come back. So as long as price comes back and never closes below the high of the first candle, what does that mean? Price is going to do what? Price will continue pushing up. Now, if we get a body closure below, well, it disrespected the bullish order flow and we'll target this liquidity right here. That's the reason why it's a really good entry. The second candle is also a really good entry. And look, that's easy. One contract. We're talking about one contract. That's only $1,000. That's it right here. And what do? We run through the last high, which is also resting liquidity. Drop a 1 if this makes sense so far when it comes to inversion fair value gaps. I'm going to go ahead and do the same thing on the higher time frame. But this is something that you can add to your arsenal, to your set of tools, your set of concepts that will really help you understand what is price doing. Again, price is either respecting or disrespecting. So here we go. Let's go to the 1 hour time frame. And let's see if we can actually find one. I'm actually going to turn this indicator on so that it can help me out just a little bit. And let's see what it does. Here we go. Okay, beautiful. Here we go. I'm going to go here. I want you guys to focus right here. Focus here. This right here, and let me zoom in just a little bit, just make it a little bit better so that it's more clear for everybody. But what do we have right here? From this candle all the way to this candle right here, that is indeed a bullish fair value gap. Look at that, bullish fair value gap, right? Can Eric drop a 2 if you agree that that right there is a bullish fair value gap? Drop a 2, okay? Now, as I extend that bullish fair value gap towards the right-hand side, what happened here? And specifically, I want you guys to tell me what happened here. Let me draw it a little bit better. Come on. Sorry about that. Let me draw one more time. Okay, so here we go. Bullish fair value gap all the way across, right? What happens right here? Why do we care? I always lose that damn arrow. Here we go. What happened right here? This candle right there. Disrespected and closed under. So now this bullish zone now becomes a what? A bearish zone. So I'm going to go ahead and put this now into red. We treat it just like a fair value gap. This is the 50%. Price the next hour comes up. Price the next hour comes up. Price the next hour comes up. And what are we doing? We are respecting price. We are respecting price at the end of the day. So let's say, for example, we are here. This is where we're at. What do we have here? This is what? Can someone tell me? What is this low at the end of the day?
Liquidity.
Liquidity. Beautiful. That is liquidity. Price has to come down here, especially if we are now respecting a bearish zone. Now, let's say, for example, you go with one contract and you hit this for TP. Let's see what would happen over the next couple of hours. Mind you, it's 3 o'clock in the morning, London session. Just to let you guys know, this works across any time frame. Asian session, London session, New York session. It works the entire time. And look, you could have put a stop loss at that candle's high. And that would have been what, 2K? Easy money. So that's how we're able to use these fair value gaps. These fair value gaps get inverted all the time. Why? Because the order flow here is going from bullish order flow to now what? Can anyone tell me? To bearish order flow. And as long as price is respecting that bearish order flow, we are going to what? We are going to continue heading lower. And that is how we're able to use it. Even on the higher time frames, we're able to use the fair value gaps. Let's go to the daily time frame. Let's go. Daily time frame. What do we have right here? Well, isn't this right here a fair value gap that got disrespected? Isn't this a fair value gap that got disrespected? What is that letting us know? And price is what? Price is closing below. The order flow just went from bullish to bearish. Right? So a inversion fair value gap helps you understand when the market shifts its order flow from either bullish to bearish or bearish to bullish. I'm going to stop right there for questions. It's 6:43 right now. We still have to cover change in state of delivery, but I want to stop right there to answer any questions, any comments, any remarks. Come off mute. Feel free to come off mute, or if not, drop it in the chat and I will be happy to address it. I see one here from Randy. What's that tool with the 50% line? Great question. So I use this one right here called, okay, so a couple of different things. If you want to do it yourself, just grab the rectangle, right? And when you grab the rectangle, it's not going to have the 50%. I want you guys to double click and I want you to click on middle line. That middle line, I always make it white. Why? Because I want to know what is the premium. By the way, what is the premium and the discount of that fair value gap? And the 50%, I want to know where that 50% actually lies, because visually it allows me to understand where price is getting either respected or getting disrespected. So that's one way that you're able to add it if you want to mark out your own fair value gaps. If you do not want to add your own fair value gaps, which I highly recommend you to train your eye to identify them, you can always add ICT imbalances by Fadi. And one of the things that I do, I change the blue to red, right? And here where it says show consequent encroachment, I go ahead and I enable that, and I always make it white so it's a little bit more visible. And as you can see, as soon as I turn that on, I have all my fair value gaps with the white line, and I have everything basically done for me. And what can we see? Look at the candle that we formed today. Look, we closed below this previous daily bullish fair value gap. Now we're heading into this daily fair value gap, which actually overlaps with a weekly bullish fair value gap. To be completely honest, if we break below this, we are going to see a lot of bearish momentum over the next couple of weeks, because we still have a lot of resting liquidity here on the daily time frame that we still have to go to. Okay. Any other questions? Any other questions, comments? Please feel free, come off mute. You guys know I like to help. I like to give out gems, information, and we still have more to cover, but I want to make sure that this, with the inversion fair value gaps, that this helps.
Chris,
I
can
have
you
a
show us the
question.
Yeah.
Sorry. Go ahead.
Sorry.
I was going to ask. Okay,
Go ahead.
I'll go after you.
Okay.
Okay, my question is, can you show us the order block again?
Yep. So we'll talk about order blocks, and so we'll talk about order blocks and also change in state delivery. We'll talk about,
Okay,
like, for
Okay.
example, this right here. This can be considered an order block. And actually, these sets of consecutive candles can be considered order blocks. The way that it is taught is that you will actually take the open, right? And as you can see, the next couple of days, did price close above that level? No. Price respected that level. So an order block is a opposing candle. And matter of fact, we'll go ahead and cover that now. So let's say, for example, this is a bearish candle. Let me go ahead and just change the color here so it's a lot better. Bearish candle. And then over the next couple of days, we expand and we displace higher, right? We expand and we displace higher. And we displace making green candles. Now, this makes it a bullish order block, right? Bullish order block. Well, the way that it is taught is that the opening, so this right here, you want to mark that out. Why? Because as long as price respects that line, we are still basically in bullish order flow. So this acts as a level of quote unquote support. That order block is a level of support for the rest of price, right? Now let's change it up around, right? Let's say we have a green candle. Yeah, I'm telling y'all, listen, we're gonna get busy today. This right here is a green candle. I changed my candle colors because I do not want it to mess with my emotions and I want it to be locked in. That's the reason why I do have it that way, right? But this white candle is actually a green candle. And what do we see? That green candle was followed up by a red candle that displaced and closed lower. So because of that, that makes it indeed a order block. So we're going to take the low right there of that candle, and that's going to be a bearish order block. The way that we mark it up is by doing the following. If it's a bearish order block, I want you guys to put minus OB. So negative order block, bearish order block, right? If you guys want to go ahead and let's say, for example, you want to go ahead and you want to mark up a bullish order block, it can look something like the following, right? And we just take the high of that red candle, and then this will be our positive order block, our bullish order block, right? So as long as price stays below, and by the way, even this right here, some people may use this as a level as well, because we did have a opposing candle create a set of red candles. This is also another level that we can also use for validation. What does that mean? It means that as long as price stays below 197.57, we are still basically bearish. If price comes ahead and we close above that right there, that's when we can potentially go back up. Why? Because now we're disrespecting that bearish order block. Drop a one if that makes sense. It was really high level, but I do have some slides that I do want to cover on Miro. And I'm also going to show you guys how we even use order blocks on the 1 minute time frame to basically validate where price is going to. So let's quickly go back into the chart. And I'm going to cover real quick another concept that you guys can be able to use every single day to understand order shift when it comes to price. What is the order shift? When is price shifting from bullish to bearish and bearish to bullish? So here we go. So it's called a change in states of delivery. So a change in states of delivery is basically when the algorithm changes from a buy program to a sell program, or a sell program to a buy program. Basically bearish to bullish, bullish to bearish. They just like to, use all this great terminology. These things happen during macro times. These things happen during macro times. Drop a one if you know what a macro time is. If you know what a macro is. AB, Kev. Okay, excellent. This is good. For the rest of the folks that do not know what that is, I will explain to you guys what that is, but basically is a period within time, or a time period where price is going to engineer liquidity or is going to rebalance price. So consider it kind of like some very small time frames where the market is really, really active. And the way that it works is that we take the last 10 minutes and the first 10 minutes of that hour. So for example, 9:50 to 10:10, that is a macro time. 10:50 to 11:10, that is a macro time. 12:50 to 1:10, that is also a macro time. These are times where the market, more than oftentimes, that order flow, that engine, whatever this algorithm is turned on to either go after liquidity or, if not, rebalance price. So a change in state of delivery is something else that we're able to use to understand when that order flow or that order shift happens. So let's take a look at this right here, right? We see that we have a green candle, and then we have a set of red candles, right? On top of that, we left behind a fair value gap. And just see how, just with the concepts that we've been able to trade, we can understand and we can look at a chart and we can understand the science and the technicals behind it. That's a fair value gap. What did price do right here? Price went up and it took the last high, right? So whenever price draws a liquidity or a level, a higher time frame level, it could potentially be previous day high, previous day low. It's going to do certain things that are going to tell you that there's a reversal, right? There's a shift when it comes to order flow. This right here was the last green candle before we had one down close candle and then another candle that actually closed below. It closed below the first green candle. So I want you guys to take the low of that green candle, and as soon as we close below it, it is basically letting us know that we are going to head lower, right? Same thing going up. If we're going up, this right here was the last red candle. This red candle led to displacement of price. So basically saying, if price closes above the last red candle, that is a change in state of delivery, right? That's if it happens with one candle. But more than oftentimes, especially on the lower time frames, it is going to happen with more than one candle. So for example, what do we see here? Green and green, right? I do not want you to take this one. No, I want you to take the first one, the first candle that created this price leg up and then led to a close below it. So that right there is a change in state of delivery, right? If we continue going bullish, we have 3 down candles, 3 red candles. We take the high when we're bearish. We take the high, we take the close of that, the opening price of that red candle. And as soon as price closes above it, that means that the order flow has now switched on to being bullish. I'm going to give you guys an example here. I actually wrote it down here for those that actually want to go back to it. I'm going to put trade ideas. I'm even going to put my own trades where you guys will be able to see them as well. But Monday at 11 o'clock, we had a really good opportunity, actually on the 1 minute time frame, for a change in states of delivery. So let's go ahead and actually show how that actually looks like. So let's go back here. I don't know why all my indicators disappeared, but here we go. Let me put the reserves. Here we go. All right, so let's go back to Monday. Tuesday, that's fine. Let's go back to Monday, which was right here, right? And it was at 11 o'clock. Here we go. Okay, perfect. So what do we see here? There's a couple of different things that we're able to understand and see. First, I want you to understand the following. If we go back here, let's say right here, and I see a comment here, let me quickly read that. It's the leg, yeah, right here, right? What happened here? What happened here? There's a couple of different things that we have here. First of all, some folks may not consider this an order block. That's their business. I consider this an order block. That's an order block. Why? Because we have a green candle that created a price leg where now we have what? A break of structure higher, right? And also drawing liquidity here at the high, right? Because liquidity was definitely swept here at the high. This is an order block. That's an order block, right? What's also super important? Well, I'm going to go ahead and just mark this out. Sorry. There you go. Boom. Right? This is an order block. So I'm going to put plus OB. What does that tell me? It tells me that if price closes below that, I'm going low. I'm taking it. Listen, I'm taking it all the way here and I'm chilling. I'm drinking my tea. I'm just relaxing. I'm taking it all the way here. Right? That is a order block. On top of that, what do we have? Consecutive sets of candles. Consecutive set of candles that made this price higher. So we can honestly go ahead and also put a line here at the low of this candle. Why? Because this is right. This is a change in state of delivery. Why? Because price just closed below the last green candle that made this price leg. So even if I go like this, right, and I go ahead and I put this TP all the way at the bottom, which by the way, on the higher time frame, that's also an order block. This right here on the higher time frame, that's an order block. But on the smaller time frames, it's going to look like this, where you can use it as a change in state of delivery. And look what I'm going to target down below, right? Or you could target a fair value gap, whatever you want, right? And price goes down. Boom, boom. You're hanging out. All right, price tries to go up. We're still respecting. See here, this is. Let's wait for it. This is where sometimes what I want to do is that I want to see price respecting that. So yeah, price didn't go all the way down to the liquidity, but we definitely confirmed downside continuation, right? Why? Because price closed below that order block, and there was also a change in state of delivery. Really good questions by Jason. Jason said, is the CSID the same or related to a shift in market structure? That's a phenomenal question. And actually, let's go back to the Miro because I have an entire slide just on that. So here we go. What makes the difference? I'll tell you what makes a difference. What do we have here? Market structure shift, change in state of delivery, and a sharp turn. All these three different things are three different concepts that can help you out to understand whenever there's an order shift when it comes to price. What do we see here? The market structure shift focuses on swing points. The market structure shift focuses on a swing point. So for example, this right here used to be a lower high. This was a lower high. And now this lower high, we see a body closure below it. So this means that now price is changing its order flow. Same concept, same different thing, just a different concept. We have many different concepts that we can use to our advantage to understand whenever price is either changing or shifting its order flow. What is the difference between market structure shift and CISD? Change in state of delivery. This is focusing on swing point. This one is focusing on the candles, right? Once we have number one, number two, we have three down close candles. As soon as price goes ahead and closes above the opening price or the closing price of that candle, the opening price of that candle, we want to go ahead and say that price is now going bullish. That's a second way, another method for you to understand when the order flow is changing. What's the third way? We talked about this all the time. Whenever price gets swept, not a liquidity run, but a liquidity sweep, you're going to see that going towards that level, price will form a fair value gap. As soon as price sweeps that level, it is also going to create another fair value gap, and that is called a sharp turn, where we have one fair value gap, we see a sweep, and then we create another one. And what do we also see? Price closed below the fair value gap. This is actually now also a inversion fair value gap. Drop a one if it makes sense how all these concepts work together. All these concepts are there together and they happen every single day.
I have a question.
Yeah. Mhm.
Can you hear me?
Yeah, please.
Okay, the fair value gaps.
Mhm.
What, when you mark them out, say you're doing day, whatever, do
Mhm.
you use that fair value gap just for the time frame that you're trading? One
Great.
day, 1 minute, 5 minutes?
Great.
Because they show up on all the charts.
You got it. Yes. So you always use so I'm showing how you can use it on any time frame, but to do a top-down analysis, right? We would actually do the following. So let's go back. Let's go back actually to today. Desktop 3. Here we go. So let's go here and let's go ahead and just exit playback mode. And what do we see? We go to the daily time frame. And let's say, for example, let's go back to this day right here. What do we see? What do we have right here? We have a bullish fair value gap. And all I'm going to do is just put the levels right here. All I'm putting is the high of the candle, the high of the first candle, and the low of the third candle, right? So let's say we go here. That day hasn't even happened yet. But what do we see? So far, we see that so far price is respecting that bearish order block. Why? Because we have a green candle, opposing candle. We take that low right there of that candle. As long as price is not closing above, we're pretty much good to go, right?
Mhm.
So now let's fast forward, and hopefully it allows me to do that. Let's go to like the 1 hour time frame, right? And these two candles is my bullish fair value gap, by the way,
Okay.
right here. Sorry, these two levels is my
Mhm.
bullish. So if I'm heading up higher, I do not want price to break below it. Why? Because if it breaks below it, what am I targeting? I'm targeting this fair value gap. I'm targeting this liquidity level. I'm targeting another fair value gap right there too, and then also this liquidity level right here, right? So let's go ahead and play it. Let's see what time is it right now. It's 20, about to be midnight, right? And once we get to like 3 a.m. London time, okay, London right here. Let's continue. Price is just doing that. What are we seeing? What are we seeing right here? Well, price just went ahead and swept these lows right here. Okay, I want to see a body closure below it. Boom, still nothing. What did price do right here? Price just took out the last low, right, and went back up. So still, so far, I'm still pretty bullish. Once I see that, I'm still pretty bullish. Why? Because price is closing above that last liquidity low, right?
Okay.
You got it, right? So let's continue. Boom. Price continues. All right, I care about this liquidity point, and I also care about that fair value gap at the bottom. Now here's where it gets interesting. Why? Because here, not only do we have a fair value gap, but we also have liquidity.
Another swing point. Mhm.
A swing point, liquidity. Let's get it. Yes, I love it. Right, liquidity right there. So I'm looking for price to actually come out and take that liquidity. Next candle, boom, right? Price is still respecting the consequent encroachment, right? So I still don't see any market structure shift. I don't see price trying to create a lower high or overtake. One way that I will get into a buy here is that let's say, for example, this bearish fair value gap, if price goes ahead and closes above it, well, that lets me know that price may want to go to this fair value gap. And I can target the 50% of that, but we're not seeing that just yet. So let's continue. Boom. What do we see? Closure below. Next candle. What does that tell me?
It's invalidated.
Invalidated. And mind you, I'm just getting into a sell right here. I would definitely get a better entry on the lower time frame. For example, if you trade off the 1 minute, if you trade off the 1 minute time frame, your 1 hour is going to be your compass.
Okay.
If you trade off the 5 or 15-minute time frame, then that's where the 4 hour will be your compass. If you trade off the 30-minute or 1 hour, that's where your daily time frame will be your compass, right? So I use the 1 hour as my guide, but the 1 minute time frame is where I'm entering every single entry, right?
Okay.
But the bias I'm getting it from the higher time frames, right? So I can see here that clearly we just broke below that fair value gap. And then on top of that, we also have liquidity right here. So I'm just going to enter a sell, and I'm going to go ahead and just target the 50% of that fair value gap, right? And mind you, I'll probably look for market shift, or if not, a fair value gap on the lower time frames to actually give me a better entry. But I'm just basing it, right? And that would have give you 2K right there, right? So that's what I'm looking for. I'm looking at the higher time frames, where the fair value gaps are at, what are my liquidity points, and whether or not price is respecting or disrespecting my fair value gaps.
Thank you. Woo.
Appreciate
So
you.
what about the do you
Yeah.
use the London session and all of that for like AMD and
Yep.
or just for NQ? Or do you use pre-market?
So usually at 9:30, I usually just come in here, literally 1 minute time frame sometimes. And I'm just looking at, what did the Asian session do? Asian will more than oftentimes just accumulate, right?
Even for regular stocks, not for NQ, for like AMD, Tesla.
Yeah, even for regular stocks. Honestly,
Okay.
I've seen these concepts have the most success on, yes, they work for options, but I've seen them have the most success for Forex and futures. Yeah, those two asset classes. Why? Because there's a lot more liquidity in those asset classes. It's trillions of dollars that are being exchanged every single day with Forex, right? So
Yeah, because I look at AMD and I'm like, all these candlesticks, they overlap. I'm like, where's the gap?
that's listen, I after I started trading futures, I will never in my life go back to options. I will never.
see.
Like, yeah, so that's how I look for top-down analysis. And again, I'm using liquidity points, and I'm also looking at changing state delivery. Let me show you another example here. Let's say, for example, you're off the 2 minute time frame. 2 minute time frame, right? And let's say this right here. Let's give this an example. Green candle, right? What did price do right here? What did price do right here?
Close below.
And close below, change in state of delivery. That's a change in state of delivery. 2 consecutive green candles, and we close below it. That's the reason why you can honestly take some of these, and watch, I'll show you right here. You can honestly take some of these trades blindly. Why? Because high, and what do we get next? That's a failure swing. That's a failure swing. We failed to take the last high. That tells you we're bearish. Honestly, with all these concepts, you guys are going to get to a point where you know where price is going, where you know where price is either going up or down, that your main job is going to be to find a good entry. That's it, right? But off of that, honestly, let's say we would have entered a sell, and let's say we would target, let's say we would have targeted the 50% of this one. That's 530, right? And let's say we would have put our stop loss. I would have put the stop loss kind of over here because I don't want it to close above that last green candle. And as you can see, it takes what, a few minutes. We're rejecting still 3 minutes of time frame, and you would have had 570 in your pocket. One single contract, right? So you can use the change in state of delivery at any given moment, right? Even let's look at another one. I want to look for a bullish one because I really want you guys to see the examples on how we're able to use this. So let's go up to yesterday, because yesterday we had some pops here and there. Okay, here we go. I'm going to put the bar to right here, and I'm going to show you guys the different entries, right? What do we see right here? Liquidity was what? Liquidity was what?
Swept.
Well,
Liquidity was swept, right? This is what? You can consider this like a micro lower high. So already, this will be our what? This will be our method of understanding that this right here is what? This is a market structure shift if price closes above it. Okay? What is this right here? You can consider this also a positive order block. Right? So plus order block. Or already 2 concepts that takes people years to master. I'm telling you guys right here how we're able to do it. Order block, market structure shift. Let's go ahead and continue. Next candle. Okay. Bullish candle. Next candle, we close above. Is that a market structure shift? Drop a 1 if you believe so. Drop a 2 if you disagree. And we'll definitely talk. Yeah, right. That is 1000% a market structure shift. That is a lower high because why? A swing point is 3 candles. 1, 2, and 3. The wick of the second candle is the highest between the one to the left and the one towards the right-hand side. That is definitely a micro lower high, right? We actually just swept liquidity. And by the way, whenever you sweep liquidity, it will look just like that. What else did we go ahead and leave? Up to no good. I like it, bro. I like your username. What do we see here? This is a bullish fair value gap. Bullish fair value gap. So now, not only are we getting a market structure shift, but now we're getting opportunities for entries. I wouldn't mind taking an entry at the order block. I wouldn't mind taking an entry at the bullish fair value gap. So let's continue. Price goes up. What else do we know? This is the last red candle, right? All of them are red. This is the last red candle right here. Actually, sorry, right here. Right here. What is this right here? Can someone tell me? When we close above the last red candle, when we close above it, what is it? We just talked about it. It is an order block. But what is the real definite is a change in what? A change in delivery. So look how we have order block, fair value gap, market structure shift, change of character, right? All these different things. And what do we have right here? That is also a change in state of, we have all the confluence in the world to let us know that we're definitely going up higher, right? So let's say you could have, honestly, anybody could have gotten in right there and you could have put your stop loss. Put your stop loss wherever you want. It will not get hit. It will not get hit. I can guarantee you that. And that's how you know when you have your trade, when your trade is actually protected. So let's say you can go ahead and target this resting liquidity of 515 that are left behind. Okay. Beautiful. Excellent. Fair value gap, bullish fair value gap also being respected. And what do we see? TP hit. Beautiful. That's 615. And you know how many? 1, 2, 3, probably like about 11 candles, so 11 minutes. It ain't too bad. So we always take trades based off the draw on liquidity, and we use the concepts that we're taught, such as market structure shift, change in state of delivery, order blocks, fair value gaps, to allow, and also inversion fair value gaps to allow us to understand that if price is going up or if it's going down. I know it's 7:14. I just want to open it up for any final questions that we have. Any questions or comments?
Chris, I got one quick question on the reserves indicator.
Yes.
Yeah, it's marked off for London at 2 a.m. to 9:30 a.m. in Asia from I guess 8 a.m. to 2 a.m. Whereas ICT marks it off at a different zone.
Yeah.
So I just wanted to get your insight on.
Yeah, so that's because it's default. So I just re-added it. So I actually have the same time frames that Michael has. I just re-added it so everything went back to default. So by the way, for those that do have the reserves indicator, you can always come in here and just change your own time frames depending on what you actually want to look at. But 3 a.m. all the way to 7 a.m. is what the London session is really about. So
Okay.
So just go back into the indicator and just change that time frame. Yeah, sorry about that.
No worries. Thank you, bro. Appreciate you.
Yeah, likewise. Thank you. Also, something else that I really wanted to teach you guys. And next class, we'll go more into time and things like that. But something else that I do, you see the 9:30? That opening candle, I also mark that as a level. I mark that as a level. Why do I mark that as a level? Because the price closes below the opening price of the 9:30 candle. Where are we headed? Down. I mean, you don't got to ask Warren Buffett that. If we close below the 9:30 opening candle, we're, like we have a body closure, we are going lower. If we are closing above it, and isn't it crazy? Isn't it crazy that everything lines up. Order block, fair value gap, CISD, market structure, break above the 930, and then boom, easy money. So the more things that you have lined up to validate your trade, and a message that I really want to tell everybody, I really want everybody to get into the mode of understanding that you need to know. And that's a gem. Listen, that's a gem. Tomorrow, I want you to do that. Tomorrow, I literally want you to go like this. As soon as 930 opens, right here, and just put it out like that. And you're going to see how price is going to react to that opening level all day. And you're going to play it, and you're going to use that level like any other PD array, or if it was liquidity. Are we going to run through it, or are we just going to do a sweep, right? Or ORB, right? So those are the things that I really want you guys to understand. But again, I really want you guys to understand, and we'll do a whole class on this, and the class is going to focus on what is your first line of defense. Everyone talks about risk management. Barely folks, listen, barely few people actually know how to mitigate risk when it comes to the market. So, yo, thank you, Jake. I appreciate you, bro. First line of defense. First line of defense is the following. If I am in a buy, what has to happen that invalidates my trade? So, for example, if I am in a buy, hence bullish, and let's say one of my fair value gaps gets disrespected, well, what is that telling you? You should probably get out if you don't want to lose all your money, right? So I want you guys to start understanding or putting into pieces what are the concepts that I'm going to start using. For example, CISD, order blocks, fair value gaps, inversion fair value gaps. What are the things that are going to let me know that my trade is now invalid? Once you understand that your trade is invalid, I think that you're managing your risk, and you have to be disciplined enough to get out the trade. So that's my last, if-then statements, just like programming. If this does this, we're going to do this. If this does that, we're going to do that, right? And actually, let me show you guys something real quick from Monday at 11 o'clock that I really want to show you. This is the last thing that I'll show for today. I know it's already getting kind of late, but from 9:50 till 10:10, that is one of the macros that usually, more than oftentimes, it does something, right? So here we have 9:50, and then I want you guys to look at 10:10, all the way to 10:10. You see the move that happened? You see the move that happened from 9:50 all the way to 10:10? And I mean, you could have used so many different things to actually get into this trade. So here we go. Let's go ahead and select the bar right here, right? And let's say this is our high. 950 is about to hit. What do we have so far? Well, so far we have bullish fair value gap, bullish fair value gap, bullish fair value gap, right? When they start getting disrespected and I see some sort of displacement lower, body closure lower, that's your cue. And what do we see right here? Price is still respecting. Next candle, body closure below it. That's already letting me know that this now turned what? Bearish zone. That bullish fair value gap is now bearish. So now I'm waiting for the next candle. Next candle goes in, but we close below. That gave it to me all. That right there gave it to me. Why? Because you're letting me know that price is looking to continue lower. Let's continue. Next candle. Price comes above again. We do not close above. And this is right here, a inversion play all day. And it happened between the macro of 950 all the way to 1010. And where we're going to go? We're going to go right here. And let's make 1410 before what? What time is that? Before 10 o'clock. Not bad. We should go ahead and just go get brunch. Bistro Cafe on me. Let's get it. So here we go. And what do we see? Boom. Easy money. Questions? Yeah, Martin, I know you like Bistro Cafe. I know you like Bistro Cafe. But that is what I wanted to cover today, everybody. These are concepts that work. I do not touch EMAs no more. I do not touch any patterns because the market is not based off of patterns. The market is based off of time. And as you can clearly see, we just talked about a macro that happens from 950 to 1010. and time. Price and time is going to get you money. Price and time is going to get you to take your family on vacation. Price and time is going to get you freedom. So next class, we'll focus more on macros. And then I have a model. Matter of fact, drop a 1 if you want me to show you a model. A model that works tomorrow, that will work tomorrow. All you got to do is be patient. If you're impatient, do not use this model. If you're somebody that's patient and you know what's your mission in life and you know what you want to do for your family and what you want to be able to provide, then this is for you. So here we go. So let's go until 10:10. I don't know when this happened, but if we go to the 1 hour time frame, all right, all I'm going to do is mark the highs and lows of my 9 o'clock candle, right? And why do I like this so much? Right? So here's one and here's another one. That's the high and the low of the 9 a.m. candle, right? This is 10 o'clock. So what do? We literally come lower to a 5-minute time frame. And guess what we're going to do? We're going to relax and we're going to thank the Lord for everything that he gives us every single day. And we're going to go ahead and wait for either sides to be purged or ran through. Why? Because it's going to give us a model, right? At the end of the day, price has to move through one of these different range areas to be able to go up higher or if not go lower. So let's continue. Price comes lower. Okay, still not yet. And what do we see? We're respecting that bearish fair value gap so far. Price closes is not, now it closes above it. Now this becomes what? This becomes a inversion fair value gap. So now this becomes a bullish zone that price can tap into and then go higher. What do we see? Price is still respecting our inversion fair value gap, our bullish zone. So price can potentially go up here. See? Price goes lower, disrespecting our bullish zone. So clearly, where are we going? Here is, I mean, is if-then statements. If it goes here, we're gonna go back here and purge 19,882. So what do we see? Price comes up. Boom. This is now where the model kind of starts. Why? Because now you want to see, are we running through liquidity? And by the way, we still have London lows that we have not tapped into, right? Are we running through liquidity or is this a sweep? So let's wait for the next candle. Always wait for the next candle. And what do we see? We are closing lower. So we're displacing lower. And this is where now you are engaged in the trade. You're monitoring. Why? Because one of the sides, one of the high, one of the levels, either the high or the low of the 9 a.m. just got purged. Price goes up. All right, we continue. This is also, we got a small fair value gap here. This can be considered a little order block that it may create. Okay, price is going up higher. Price is going up higher. So this can be essentially a sweep. And by the way, whenever you see price getting back into the range, it's letting us know that we're definitely hitting up higher. Okay. Boom. Price back into the range. Let me go ahead and just quickly remove these joins out of here. And what do we see? Right now, price is getting me back into the range of the 9 a.m. and 10 a.m. candle. I want to see if we're going to disrespect this bearish fair value gap here, which the bearish fair value gap is right here. Look. And what are we seeing? We are closing above, so we could potentially get into a buy here. Let's see. Boom. Beautiful. 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 And what are we going to target? Beautiful. Beautiful. Let's go. Let's go up. Let's go for that high. Beautiful. There we go. Done. 3,440. Drop a 1 if this makes sense. Honestly, there's shiny things everywhere. In life, you're gonna come across shiny objects everywhere you go. The cars, your partner, your trading strategy, whatever you want, your house, shiny things everywhere. What do I want you to do? I want you to focus on one strategy. How the heck people Do not focus on one strategy, not even for a month, and they already see that they can't trade. No. It's not that you can't trade. You're not patient enough to pay the price and pay the discipline and pay the work that it takes to become profitable. That could be somebody's model right there. I'm going to engage at 950 and just trade the 950 to 1010 macro every day. You know what? I got meetings in the morning. I'll trade the afternoon macro from 1250 to 1010 and see how that goes. And I'm going to do demo for the next 30 days. And I'm going to journal every damn trade so that I can become better. People have lost the tenacity. People have lost the grit. That's why it's so easy to outwork everybody. Honestly, it's very easy. Why? Because people are so damn lazy. But if we stuck, even 9 EMA and 21 EMA crossover, that shit still works. Is retail trading, but if you focus on it for a month, I'm pretty sure that not only are you gonna be profitable, but you're also gonna learn and you're gonna fine-tune your model to then make it more profitable. So this can be someone's model. So if we go to the 1 minute and hopefully, oh yeah, it does let me do the 1 minute. You honestly could have caught this all the way down here. This could have been your entry right here, by the way. This was the perfect entry for this right here. Why? Market structure shift overlapping with a fair value gap. Market structure shift that overlaps with a fair value gap, we running it. All we got to find is a good entry, right? Price goes down, and where does price goes down to? The fair value gap, which is right here. So it's always going to give you a model. Even on the 1 minute time frame, it's going to give you a model. And if we go ahead and play it right back, let's play it right back so you guys can see the numbers that you're able to do. And again, we got the high, we just swept this liquidity. Let's go for one contract and let's go ahead and just trade up here. Let's trade up here, boom, right? And why did we get in there? It came to the fair value gap. What is that? That's a break of structure that we're getting on the 1 minute time frame. Price comes down to the fair value gap. That could have been another entry. Come on now. Another entry. Put your stop loss below. You still making money. Still making money. And it just runs all day. It runs all day. So I really want you guys to commit to becoming an expert when it comes to the markets. Like my goal is to become a surgeon. Like I'm so serious when I tell you guys, I want to become a surgeon. It has to be surgical. If it ain't surgical, I don't want it. That's honestly how it is. So with that being said, I want to thank everybody for the great class, for the great engagement. This was our third class part of the series. I highly recommend you guys to send it to anybody that's into trading, is struggling with trading. They don't know these concepts. They're still stuck on retail trading because probably one of their gurus is still talking about that stuff and they don't really trade. I'm telling you, this stuff works. And as you can see, we signal every single day and we tell you exactly where price is going. So with that being said, thank you again.
One question before you go, Chris. Sorry.
Yeah, please.
Does your Discord teach futures for beginners?
Yeah, so I'll say this. We have classes that Lay has given on futures. Pre-recorded, yeah, we do. Yeah, so in the VIP we do. One of the projects that I do have for before the end of the year is that I would like to go to a state or a city like Atlanta, Miami, or New York and do like a workshop style, type of event where we stay there for 1 or 2 days and we have 8 hours of teaching. And everybody can get together and the whole scope out of that is that everybody understands these concepts so that they can then become a funded trader and they could start getting payouts every month from Top Step, from Apex, from My Futures Trades, all these different programs. That's definitely the goal. And I truly believe that we could definitely generate 6 and 7 figure earners with this type of knowledge. So that's the goal. But we do have pre-recorded sessions.
Okay, thank you.
Yo, one quick question real quick.
Yep.
So I know you've been doing this on future and also like the stock market, but how reliable is it also like within Forex?
Oh, very reliable. Oh yeah, this is where everybody's on right now. Like if you look at Twitter, everybody wants to learn ICT. But the problem with ICT is that I love ICT, by the way. He changed the game for everybody. But the thing about ICT is that those videos are hours long, 2 hours, 3 hours. He starts talking about trading, then he talks about politics, then his son, and then this and that, and then Ferrari, and then all these different things. So to get it simplified is critical, and that's what we're trying to do here. But Forex this is a gold mine. For gold, it's a gold mine. Like I can go right now and put XAU USD. Let's see, right here, and we could take it to the daily time frame. And just here, we can understand what's going on right now. And what do we see right here? Well, we have a consecutive set of candles that formed this displacement. This right here is a bearish order block. And so far, today's candle went ahead and we respected this order block right here. We are currently respecting the order block and we're closing below. So I wouldn't be surprised if tomorrow we expand again and we take this low right here of 23.84. Matter of fact, I'm going to go ahead and put an alert here, and when it hits, I'll definitely let you know. Let me put it right here. 23.8. Let me put it right here. There we go. Yeah, right there. I'll put it right there. Yeah, so this works on absolutely everything. And what do we have here? This is liquidity. This is liquidity. This is liquidity. Fair value gap right here. Bearish, bullish fair value gap right here. A really small one that price was respecting the last 2 days. It works on absolutely everything. And these are regular candles. These are not Heikin-Ashi. This does not, this can work on Heikin-Ashi. I just haven't tried it, but I know that it works really well on the regular candles. And for those that want to have their chart like this with the white and black, all you got to do is double click on the candles. And then here you can change the body wicks, the borders and everything like that, and make it look white and black with the black background. So it works for absolutely everything that has enough liquidity.
Nah, that's saucy.
Excellent, excellent, excellent. All right, yeah, appreciate you guys. Have a great Wednesday evening. Make sure to be grateful every single day, and let's continue winning. Let's go. Let's get it. Appreciate you guys. Take care.